Let me start with a number that should bother you more than it does. The United States is now nearly $40 trillion in debt. Not billion, trillion. And it's going up by about $8 billion a day. And the way the government deals with that much debt is, in the end, to print more money. But here's the bit that actually touches your life. Every time they print more dollars, the dollars already in your purse buy you less and less. And it's even worse if you're holding currencies like pesos and rupees. It's why your groceries keep going up, but your money doesn't. That's not bad luck. That's the money itself losing value. And this is the whole reason Bitcoin exists. It was built so that no government can print more of it. There will only ever be a fixed amount. 21 million Bitcoin. A lot of people see it as a way to protect what they've worked for from a currency that keeps getting watered down. You don't have to agree with all of it, but that's the idea. That's why we're all paying attention to it. In the next few minutes, we're going to set up the Bitcoin chart from scratch together. And I'll show you how to read the bigger picture around it. And then use the whole thing for something most beginners get completely wrong. Because it's not just about finding the perfect moment to buy. Nobody does that. It's about understanding what you're buying so you can do it sensibly. Stick with me to the end for that part, because it's the bit that actually protects your money. Now let's build our actual Bitcoin chart together. Before I draw a single line, there is one thing you have to understand about Bitcoin. It moves in fairly predictable 4-year cycles. And it has done since it launched back in 2009. The reason is something called the halving. Roughly every 4 years, the rewards paid to computers that secure the Bitcoin network gets cut in half. Less new Bitcoin gets created, and historically, that is kicked off each big cycle. For a long-term investor, that is genuinely useful, because it gives you a rough window every 4 years where it has tended to make sense to add more. And that window is usually the opposite to when your friends and family are telling you to buy. If you want to go deep on the cycle and the halving, I've left resource in the description for you. Okay, first thing we're going to do is mark out those halvings and even the upcoming one. Now let's add the stochastic. And guess what? We see a clear pattern. Before Bitcoin's first bull market, we had the stochastic had oversold. A couple of months later, we had the first halving. And a year after that, we had the top of the 2013 bull market. And then you can see how this is repeated. Not once, not twice, but 3 times after that. Every time the stochastic bottoms first, then we have the halving, and then we have the top of the bull market, a year to a year and a half after that. That's why I'm making this video now. Currently, the stochastic is oversold. It hasn't crossed over yet, and we're still just under 2 years from the next halving. So on the monthly, we're going to draw in our support and resistance levels. These are all based on candle closes, not the wicks. I'm drawing the all-time highs and the bear market lows, and the major turning points in the last 2 cycles. These are the support and resistance levels that matter. Now our Fibonacci. The first one is on the last bull market, from the COVID low to the high. And look at that. The bottom of the bear market that followed bounced almost exactly off the 0.786. That's not magic. That's where smart investors paid attention. Okay, now I'm going to clear that and draw a fresh fib on the most recent bull market, the one that topped out last year, from the bear market low to the candle closes of the all-time high. And here's what I find interesting. In this whole cycle, Bitcoin has not yet come down to the 0.618 or the 0.786. So those are the 2 spots I've personally got my eye on to add more. Both of them line up with other levels. So there's more than just one reason they matter. When I look at potential bounces from these fibs, the Fibonacci target at the 0.5 extension is around 165,000. So buying near the 0.618 is roughly a 3x, and buying around the 0.786 is roughly about a 5x to my target. That's my thinking, not a prediction, not a promise, just where I'm looking and what the numbers give me. This target would be 3 or 4 years out. So as a longer term investor, that's what I'm thinking. Now the trend. Let's move down to the weekly. Last time price slipped under the 200 EMA like this, the red one, it actually turned out to be a decent place to start adding. And that's roughly where we are again now. And one honest difference is that last time we had one of the other moving averages below the 200 EMA, and we don't quite have it yet. The other thing I always want to see is the moving averages bunched together, because that's usually when the calmest accumulation happens. Right now, they're still spread out and angling down. the 55 and the 21 EMA. So it's not perfect. But if I was worried about missing out entirely, this is the area where I'd start steadily adding rather than waiting for the perfect signal that never comes. Stick with me, because I'm going to explain how I do that in a minute. Everything so far has been big picture investor view. If you actually want to trade this, we drop down to a lower time frame, the daily, and it looks completely different. Let me show you quickly, because seeing the difference is the whole point of our next video. I'll draw a fib on the current wave. For a bullish trade, the stop goes 2 lows back, and the take profit up to the 0.5, expecting that moving average to drop down and meet it. But when I measure it, the risk to reward is just over 3. Barely worth taking, honestly. And to see the bearish side, I flip the fib upside down. From the high to the low. Same story. The risk to reward is only about a 3 from here. What I'd actually want is to short from closer to 66,000, where this key resistance sits, which would give me a much clearer move down and a better risk to reward, actually aligned with the current trend that is still down, right into the same level where I'd want to be investing anyway. And I know, you might have clicked this video asking, where do I buy Bitcoin? And now this crazy woman is talking about short selling it. But that's the whole point. This was the trading scenario. And trading is a different game with different rules. For investing, the move is much calmer. You buy little by little and put more in as price comes down to your levels. Let's look at the dollar. Now, why do we care about the dollar when we're looking at Bitcoin? Because almost everything, including Bitcoin, is mostly priced in dollars. If you want to see the dollar on a chart, we're going to use the DXY. And all it measures is how strong the US dollar is against other major currencies. The euro, the yen, the pound, and a few others. When the DXY moves up, the dollar is getting stronger. And when it goes down, those other currencies are gaining strength. The strength of the dollar itself is a bit like a tide underneath everything. So when the tide goes in or goes out, it drops or lifts everything floating on it. And Bitcoin is floating on it too. So we check the dollar first, the same way you check the tide before you go surfing. And the way it usually works is this. When the dollar is strong and rising, that's normally a headwind for Bitcoin. Money runs towards the safety of the dollar, and riskier things like Bitcoin or tech stocks tend to struggle. They mostly move opposite to each other. And when the dollar is weak and falling, Bitcoin usually has room to run, because money starts looking for somewhere else to go. I'll be honest with you though. It's a loose relationship, not a rule. They don't move perfectly opposite every single day, especially on lower time frames. It's a lean, a bit of a background, not a signal on its own. And right now, the dollar is sitting in the lower part of its range and wobbling around rather than shooting up, which is a reasonably comfortable backdrop for Bitcoin. That's all we need to know from this one. It's not a buy button, it's a weather report. The second one we look at is Bitcoin dominance. On the chart, it's BTC.D. And all it shows is Bitcoin's share of the entire crypto market. So if the whole of crypto is one big pie, dominance is just how big Bitcoin's slice of that pie is. Right now, it's sitting around 59%, which means Bitcoin on its own is more than half of the entire market. And the reason this is so useful is that crypto really only has 3 buckets. There's Bitcoin, altcoins, and the growing stablecoin market, which is also dollars. Money is always sloshing back and forth between these 3 buckets. And dominance is how you see which way it's flowing. It's honestly the quickest way to read the mood of the whole market in one glance. You can also look at stablecoin dominance on its own chart. So when Bitcoin dominance is rising, money is moving out of altcoins and stablecoins into Bitcoin. That's usually a good sign for Bitcoin. And when Bitcoin dominance is falling, it's the opposite. This often aligns with the DXY rising. One thing that catches people out, Bitcoin can still be going up in dollars while its dominance is falling, simply because the altcoins are going up even faster. So in this case, a falling dominance line is a heads up that the excitement has moved somewhere else. And this is exactly the kind of thing I write down. When I look at Bitcoin, I note where we are in the cycle and what my plan is. So I'm not making it up in the moment when the price is jumping around. I keep that in the journal in the free Moms Who Trade app. The point is, the plan exists before the emotions take over. Hit the like button and subscribe, and keep learning with me for free. because what I'm about to show you is the whole reason we did all of this. Here's what it's actually for. And that, finally, is dollar cost averaging. The textbook version is simple. Instead of dropping one big lump in and praying you got the timing right, you buy smaller amounts over time, so no single purchase has to be perfect. A lot of people buy fixed amounts every month without even looking at a chart. And honestly, that alone beats what most people do. But I'll be straight with you about what I actually do, because it's a bit different. I don't just buy blindly every month. I use the chart. I start steadily adding at the right time, and then I buy bigger amounts when price comes down to my key levels. Same idea as dollar cost averaging. Spreading my buys out so I'm never betting everything on one moment, but I'm letting the higher time frame tell me when to lean in harder. And that's where the chart work pays off. It doesn't tell me the perfect moment. Nothing does. It gives me context. Up near the top of the range, I'm patient and I ease off. Down in the discount zone, near those levels, that's when I lean in more. I'm not planning it to the day. I'm understanding where we are and buying with a plan instead of a panic. This isn't financial advice, by the way. I'm showing you the method, and what you do with it is your call. You can open up a Bitcoin chart, read the weather, read roughly where we are, and use it to buy with a plan instead of a panic. That's a real skill, and most people never learn it. One skill at a time. See you next time.